the dilemma for the Fed. There's more work to do for inflation to come down, so says Jerome Powell, but clearly the Fed do not want to over-tighten. They're watching the fallout in the real economy. That requires a more nuanced approach. If so, what does that look like, Danielle?
So I think the Fed chair today articulated that nuance is going to come in the form of no more unusually large rate hikes. Nothing that he said in his press conference led me to believe that 50 basis points on February the 1st was even in the cards. That said, he has also been maintaining that he's going to get the terminal rate, achieve the terminal rate that, as you said, was higher than what the market was anticipating going into this meeting, and keep it there. And the implications there for liquidity and credit, they cannot be understated, because quantitative tightening is going to continue to move along at the fastest pace that we've ever seen. If you believe in flows versus stock, and I'm a believer in flows, if you believe that this liquidity depletion is going to continue through 2023, which is what the dot plot, it's what it communicated today, then we're really going to be having the potential for contagion emanating from the credit markets into the real economy.
Right. Let me just pick up on that, Danielle. If this monetary policy free-for-all and large S is now categorically over there, and capital is being repriced and capital allocation is supposedly more disciplined now, do we see more blow-ups and financial accidents like FTX? And is there anything potentially on the horizon that could be systemic, in your opinion?
Well, I do think that there's the potential for cross-asset contagion, specifically emanating from the commercial real estate market. In the year 2023, we have more refinancings in commercial real estate than any year through 2032. This is a byproduct of so many 10-year loans that were underwritten in between 2010 and 2012. If we start to see a large, major, multi-trillion-dollar market like commercial real estate start to teeter, confront the inability to refinance, I think that you could see spillover effects into other leverage markets, leverage loans. We saw Blackstone put a gate up on a private debt market last week. That's a $1.4 trillion market that's 68% owned by U.S. public pension plans. So you start to see the ripple effects that could emanate from one sector effectively contaminating others as this liquidity depletion and maintaining a high level of short-term interest rates continues to batter at the economy.